Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fine.
Good morning. All right. Well, it is Tuesday. This is a pretty light week news-wise, but we do have a lot of Federal Reserve speakers, and we've got other stuff happening. Although I am okay. So let's go into the charts, and I'll talk about what I'm thinking here right now. I'm honestly a little bit confused. So let's start with the Treasuries. Okay. So yesterday we had, over the weekend, Moody's downgrade U.S. debt. Markets sold off, but they pretty much recovered it by the end of the day. Which, you know, I've kind of said they tend to just ignore those things. All right, because it doesn't really change who can buy the treasuries. There is no alternative. Pina. All right, so in the overnight market, a little bit of back and forth, maybe a tad on the sell side this morning, but we'll see. They are pretty tight. Come back over here on the DOM. Pretty tight range so far. Okay. S&P 500. Oh, did they buy the dip? Right back up there. Oil and other commodities are kind of trudging along. I'm hearing stuff about like caps on Russian oil and so forth. Gold and silver pictures look kind of similar. It's kind of interesting. I see echoes of gold and silver in oil and the rest of the commodities complex, frankly. Copper here. Copper is really back and forth. Whew. Okay, now the Japanese yen. So yesterday there was, or last night, overnight, there is what Zero Hedge is calling a failed bond auction. So they went to auction off new debt, and there was not really anybody there to buy it. But the Japanese yen didn't really do anything. The treasuries didn't really do anything. So I was kind of gearing up to maybe have to deal with something. I was wondering if we would see the Japanese yen fall and more people move into treasuries or something like that. Well, there is this little spike right here that might have been the auction. So it may have pushed U.S. treasuries up a little bit. But overall, it seems like a non-factor. And here we have Bitcoin pumping hard again up into the 105,000 range. So we'll come back here. Now let's take a look here. We did just get Canadian CPI. Canadian CPI month over month negative spot 1 versus an expected negative spot 2. Oh, it's almost like tariffs are being deflationary and not inflationary. So we got Bostic speaking. Trump is going to speak at the House GOP conference. Barkin, Collins at or around the open. Trump speaking in 9:55. So we've got some speakers. And if they're really not going to react to the Japanese yen stuff, then I'm not sure we really have a good market to trade here this morning, to be honest with you. We are, I mean, the cost basis is pretty tight, but we are pretty considerably below that. The cost basis above us would be 08.5. So I think the easiest play here is probably we'll watch the treasuries sell off a little bit on the open and then revert back to that line. That's what tends to happen in this situation. But let's see. Maybe the bond vigilantes decide to take another run for it. I've been noticing, man, I tell you what, a lot of people still hate this rally, right? This rally in the S&P 500 is just bewildering to many. I think that it makes complete sense. Like what we saw in the stock market in March and April was absolute, complete panic and carnage in the stock market. People way overreacting to what the economic situation actually is. Like, tariffs are very, very impactful, but not a recession. There was maybe a point where, depending on what Donald Trump did, could have been a recession, but it didn't happen. You know, the functions that we have to stop that sort of a thing came in and saved it, right? So it was not so bad. So now what do you got? You've got a bunch of people short and nowhere for the money to go other than back into the stock market. So what happens? All those shorts get squeezed. Yeah. The problem that I keep seeing is everybody seems to think that the S&P 500 is supposed to reflect the actual state of the economy. And no, it doesn't, because first of all, the stock market is not the economy. The majority of the economy is in small businesses. But then B, financial markets aren't informationally efficient. The current price does not reflect all available information. It reflects the orders placed into it. One of the largest factors in the orders out there going into the stock market is just how much money is out there to invest in the stock market in general. And so it becomes a measure of like liquidity flows. And in this case, there was a bunch of money that came out of the stock market and then it didn't have anywhere to go. So it just went back into it. We're back at all-time highs. Well, not all-time highs, but you know, we've recovered most of it. If there's anything I've learned through this whole episode that we've had with tariffs, by the way, it's that Reddit sucks at trading. Oh my gosh, Reddit sucks at trading. These guys, they have been short the whole way. They have been fighting this rally the whole way. They have been against basically every move. They have been short equities and short treasuries. And, well, they had a little bit of a reprieve last week. You know, treasuries sold off pretty good. So I think that they were happy about that one. But now they're getting frustrated again. Because that's like still like just where they opened their shorts from. They're bad. I'm kind of wondering now, I can just go to r/Wall Street Bets Elite and take the opposite trades of whatever is popular over there at any given day and make money. Like, that's how bad it has been. They are just absolutely terrible at trading. And, well, I think it's just kind of a reflection of a much broader group of people, right? That especially left-leaning people, they have been overly scared of tariffs, essentially. So I don't know where that leaves us today, but which direction are you going to trade if they do speak about Japan? Well, so if I was seeing if I was seeing flows off of that failed auction in Japan, well, I could see it going both ways. I could see, well, Japanese debt is selling off because interest rates aren't high enough to entice buyers. And that's like a competitive sort of a thing. And so maybe if you saw yields rise in Japan, you would see yields rise everywhere. So that's one possibility. Granted, I think that you would have to see yields rise considerably to see any kind of change. Like, how are you going to get people to buy Japanese bonds instead of US bonds? Like, I think you make a little bit now with Japanese bonds, right? You make a little bit now. Whereas if you come over to the United States, you're getting like 5%, right? Like, that's crazy. But it could be the opposite. It could be, even more money is going to be, so like, yeah, yields are rising and that would maybe attract more buyers, but it's probably still not enough. So maybe some people just get scared. They say, well, the Bank of Japan can either A, launch more quantitative easing and zero interest rate policy and basically collapse their currency, or they could allow the yields to fall further, and anybody that bought Japanese bonds is just absolutely screwed, which would probably mean a lot of failed financial institutions, right? So maybe if I have my money over there, I say, you know what, it's not worth the risk of being invested in Japan. I'm just going to take my money elsewhere. Maybe I will go over and just buy some treasuries with it. So, and I do think that was maybe that big spike that we had around 3 o'clock in the morning Eastern time. Might have been that. So I am kind of sitting here on the lookout for some buying flows. Right now, we are at the lower end of the range now, so it's kind of looking like, we could get a good trend lower. But I'm not really seeing much volume at all interested in it. So that I'm kind of thinking they're going to test lower, and then when the buyers take their turn, you'll see the buying is stronger. That's what I suspect might happen today, but I'm not sure. I think that it'd be hard to take a trade today. I think that I don't know if I have. Well, if I see a strong flow come in long, I suppose I could go long. It's a Tuesday, but I'm doubtful of it. I think it's possible, but I think it's doubtful. I'm not convinced that the predictor of order flow that I've got here and the flow that I'm predicting could come is really going to be strong enough. And if anything, it's just going to be like a failure on the downside and mean reversion. That's not necessarily going to be a super powerful flow or a really good high probability trade. So thank you for what you've been doing. Thank you. Oh, I saw your comment. I appreciate it, man. J-Dub, I agree. Tough day to trade any commodities on your mind like corn or oil. Well, you know, I haven't really... I honestly... I try to keep an eye on the commodities. I look at them every day. But nothing in the commodity complex has been sticking out to me. That is, I find really, really curious that in this situation with tariffs and everything, it kind of feels to me like the commodity markets have been like abandoned. I don't know what to make of that. And I haven't, not only that, but I haven't really seen any good research from the major Wall Street analysts about commodities in general, except for gold. Except for gold, many of them are very bullish gold. Well, I'm just kind of surveying the market over here again and not really seeing anything too terribly interesting. So, by the way, you know, I have this inside bid ask added to my strategy. And one of the things I want to note is that you can kind of see, granted, there's a lot of noise in this because it's just showing me what the inside bid ask was at the end of that time period. Okay, so you might need a more granular time period to really see what's going on there. But on the 1 minute period, do you see this right here on the chart? Maybe, should I make it bigger? See this right here? It's like all of a sudden, especially this bar right here, all of a sudden, not very strong bid or very strong offer. What's going on there? It's a liquidity hole. Do you see it? Markets tend to rest at places where supply and demand are at their minimum. And so the liquidity providers, they don't want to put up a whole lot at any one given time, and that kind of makes markets just go sideways. Well, right now, we're not necessarily getting that. Actually, we're getting relatively large bids and offers. Minimize that. That offer, almost 3,000. Tariffs, like in my mind, if stocks are crashing, the only thing safe would be physical goods or items like corn or oil that would spike. Yeah, but they really didn't. Gold did spike somewhat during those times. I find it really interesting. Gold will perform in those or has performed in those situations. I won't say it will, but it did perform in those situations. But it was never like a clean correlation. It was never like the S&P 500 was going down and for every bit that the S&P 500 went down, gold went up. It was like the S&P 500 would go down that day, and then like the next morning you would see a ton of buying in gold or something like that, right? So the way that gold has been moving has been very, very like stop and go and a little bit unpredictable, I would say. Do you think gold and Bitcoin are correlated? So yes and no. So for one thing, they do tend to be a part of the interest rate complex of sorts. So, you know, when we see that, I'm not going to say that treasuries are going up or down, but when we see that investors are concerned about things like, you know, too easy policy, you tend to see gold go up and you tend to see Bitcoin go up. I wouldn't say that they're necessarily correlated. Again, it's like, you know, you might see a move over here on Monday and a move over here on Thursday or something like that, right? I think, though, that Bitcoin still seems to be driven primarily by injections of liquidity through Tether. They'll print like $1 billion in Tether at a time, and when that happens, Bitcoin moves up into the next range. They'll move up into the next range of prices, and then everything goes dead again. It's like nobody's interested in trading Bitcoin anymore, even though it's going up. Meanwhile, But especially during 2022, when we were really concerned about inflation, gold did not act as a safe haven as it usually does, and Bitcoin did. So I think that there is some evidence to suggest that some of the demand, that gold has lost some of its demand in competition with Bitcoin. That's kind of wild. But I'm sure if you were to go and you do statistical measures of correlation, you would the correlation's not very high. Why do you think U.S. debt got downgraded? Well, the reason that U.S. debt has been getting downgraded has been because of political instability in Congress. Essentially, the rating agencies are concerned that there will be a situation where Congress will not be able to make a deal to raise the debt ceiling, and the United States government will default on a payment as a consequence. I think that is somewhat unlikely to happen, but not super unlikely to happen. It's definitely within the range of possibilities. And frankly, if it did happen, I'm not convinced that it would actually be like the end of the world kind of event that a lot of people think it would. So one of the stories I remember, it kind of dominates my view of this guy, I think, but Ray Dalio, he's the owner of like the largest hedge fund in the world, right? It's the largest hedge fund out there. And one of the things that happened was he was telling everybody like Mexico's going to default on its debt. Like the situation in Mexico is super, super bad. This was like back in the 70s or 80s, right? And basically, he was right. Mexico like defaulted, and he didn't make any money from it. He lost money big time because the markets did not react to that event the way that he thought it would. The markets basically shrugged it off as a non-event when he thought that it was gonna like collapse the entire global financial system. Right? I think that the U.S. defaulting on a debt payment would probably be a similar thing, where, yeah, I'm sure that it would cause a lot of volatility in the short term, but in the long term, probably the markets would recover and then just move on like nothing ever happened, because it still comes back to like, where are you going to go? What else are you going to do with your money? I'm not sure anybody even knows there are alternatives, you know? See, if China was like a really, really strong alternative to put your money into it, right, then it would be a different issue. But nobody trusts China. Has the U.S. ever defaulted on their debt? I don't know. I think maybe they have. Let's ask ChatGPT. Has the U.S. government ever defaulted on debt? ChatGPT, yes. You want me to read? You want me to have it read it for you? I forget where you. I think you have to wait for it to finish to get it to read it out. Maybe it says the book is too thin. What I continue to see is a relatively strong offer, a relatively weak bid, and them just trading back and forth across that price over and over again.
Yes, the US government has technically defaulted on its debt a few times in history, although not in the catastrophic sense that people typically imagine. Here are the main instances. 1. 1933, abrogation of the Gold Clause. What happened? The US Congress passed a joint resolution that invalidated the gold clauses in public and private contracts, which required payment in gold or gold equivalent. Impact: bondholders were effectively paid back in devalued dollars rather than gold, resulting in a real loss of value. Legal response: the Supreme Court upheld the decision in a series of 1935 cases. Considered a default? Many economists consider this a technical default because it altered the terms of repayment.
Okay.
2. 1979, temporary delay due to a technical glitch. What happened? A combination of a backlog, a temporary failure of word processing equipment, and an increase in the volume of Treasury securities led to delayed payments to holders of Treasury bills. Duration: only a few weeks. Impact: investors were eventually paid with accrued interest. Considered a default? Yes, technically, as it missed scheduled payments, but it was due to operational issues, not insolvency. Debt ceiling crises, numerous near misses, not actual defaults, but close calls. 2011 and 2023 debt ceiling standoffs created serious concerns in markets. Credit rating agencies responded. S&P downgraded the U.S. credit rating from AAA to AA+ in 2011. These events raised the risk of default and
So
caused
keep in mind we are
volatility,
shortly
but the
expecting
U.S.
the
ultimately
ECB
met its
bond settlements for the
obligations.
week.
Summary: year, event.
Oh, no, you're not going to read that whole summary table, are you?
1933, Gold Clause
Again,
abrogation.
we're also just a couple of
technical.
minutes away from
Changed
the
repayment
top of the
terms by
hour as
abandoning
well,
gold
where we're
payments.
expecting a text release from
1979,
Fed's
payment
Barkin,
delay.
possible comments
Technical.
from Fed's
Operational
Bostic,
delay in redeeming
and
Treasury
Trump due to be
bills.
speaking at a House
2011 to
Republican
2023.
conference as well.
Debt ceiling
We'll see if we can
crises,
find a video
near
for
misses.
this.
Politically induced risk of default. So, while the U.S. has never defaulted due to insolvency, it has defaulted technically in the past. The distinction between technical default and economic collapse is crucial when assessing U.S. creditworthiness.
There you go. So, and that would be what would happen, right? Is Congress maybe wouldn't raise the debt ceiling, which would result in missed payments. It would be defaults, but not because of insolvency, but because the U.S. government is malfunctioning or dysfunctional. And probably what would happen is eventually Congress would make a deal, and then bondholders would get, those payments would get paid plus interest or something. So I think that scenario is a real possibility, though. Okay, so we're going to get Barkin here in a second. Bonds might be the perfect holding position. Well, the problem with bonds is, what could you have put your money into that would have paid you more? Because oftentimes the rate that you get on the bonds doesn't even really make up for the inflation. Downtick. If you hold the bond all the way to maturity, pretty hard to lose money. But if you have a bond and it makes 2% and you had 5% inflation, like what happened in 2021, 2022, then you basically have less money because, yeah, you have the same amount of money, but inflation is higher, or the prices of everything is higher. And that's the risk with treasuries. That's the risk with being on fixed income instruments. Is that the value of your bonds or your fixed income instruments doesn't keep up with the rate of inflation. Yeah, they're just poking fun at the fact that at least in every situation they got their money back in those. Yeah. Well, it's kind of funny that like when a stock goes into bankruptcy, the bondholders get paid back first. Okay, I guess we're hearing Donald Trump. Was that him on Truth Social? Oh no, he's speaking to reporters ahead of his meeting with Republicans. Well, what comes out of that conference meeting might be significant. So what's going on right now is the Republicans want to do some sort of a budget deal, and they want, as part of that deal, extension of the tax cuts from Donald Trump's first term. And a lot of people are saying that, at least according to the CBO, the Congressional Budget Office, that the changes would result in less revenue and would increase the deficit. And Republicans will say, no, that's wrong, because it will result in more economic growth, and so we'll actually get more tax revenue. I remember this being a big thing in Donald Trump's first term. They said, oh, revenue is going to go down. And then it didn't. It went up. And then they said, no, that was still like that revenue you would have gotten anyways. But if we had kept the revenue high, if we had kept the rates high, we would have made even more. So they refuse to accept the premise of this idea that the tax cuts can result in more economic growth. And even if that's what happened, and I'm not saying that it did, but let's just assume that it did happen, they refuse to accept that that's why it happened, and so they don't count it. Kind of a weird thing that you're going to see in the political argument about this, right? But overall, I don't think that the market was too happy with the budget deal that they were hearing about. And it didn't sound to me like the deal that they were talking about was really going to get done. So they probably are rallying the troops and trying to gear up for go in a different direction, and we'll see what that is. You think we're due for a collapse due to inflation? Oh no. Inflation is really not a concern right now. I think that through all of this, and granted, most of the tariffs that we were expecting to see, we're not actually seeing, right? Because they backed off on all of this considerably. So the actual net impact of tariffs is right now pretty small. But what we have seen so far is not inflation. We have seen, frankly, deflation. We've seen a collapse in demand for a lot of goods. And even though some goods are going up in price, that is coming at the expense of other things. Primarily, services. Basically, companies cannot pay as much for services and so forth to make their products. And so like the overall net inflation is not really moving up. But most of the tariffs haven't hit yet either, right? So you're probably going to see periods where these numbers kind of move around wildly, where one month it's really, really low and next month it's somewhat high and it oscillates back and forth. But, another thing is that it seems to me that there's quite a bit of wiggle room for interest rate policy, especially when it comes to there are some periods where it really, really matters. Like in 2022 or whatever, at the beginning of Biden's term, the Federal Reserve kept interest rates low for too long by several months. And that was primarily responsible for the massive inflation that we got. There was like 3 different things going on, right? Supply chain concerns, fiscal policy, monetary policy. But what happened was the effects from the supply disruption and monetary policy subsided, and monetary policy did not. Monetary policy was the only thing that was pushing things. And that was the point at which the market no longer needed the liquidity and the Federal Reserve was still giving it. And so the Federal Reserve being late seems to be the last big mistake. If the Fed had if the Fed had hiked 3 months earlier, probably wouldn't have been nearly as bad. So there's a situation where it matters. Whereas right now, there's a lot of problems. We could really use some lower interest rates. I think that some of these, having interest rates at 4.5%, 5% in some instances. I can't see what it is in the 30-year right now, but actually that's Y2K5. I don't even have that on the 30. Oh, it is 30K25. Oh, okay. Yeah. The 30-year. It's correct. It's just nobody's even put any liquidity out there, so you can't see it. But I believe it's around 5%. I think that's just too high. There's a lot of businesses out there in the United States that just can't handle that. We're not seeing a lot of investment. We're not seeing a lot of entrepreneurial type activity. As a trader, not an individual, do you prefer Trump or Biden? Meaning strictly as a trader, do you think you have more trading opportunities under? Well, we definitely had more trading opportunities under Donald Trump's first term than we did under Biden's term. Biden's administration was so boring, relatively speaking. But I wouldn't say that Donald Trump's second term has necessarily resulted in super good trading opportunities. We used to be able to, catch a tweet and ride a wave, and there was things like that would happen all the time. These days, it seems like that Donald Trump speaking is he'll say something and there will be a one-time move, and they're too fast for a retail trader to really take advantage of. And that that possibility is out there, so you're less likely to get in a position. So I think that overall for me, Donald Trump's second term has resulted in less trades, or I have taken less trades at least. But where the markets are going to be the best for us is when there are situations where we can take advantage of informational asymmetries. So, here in this situation, I think I've made more overall because, I do have investments in the market and so forth, and I've done really well with all of that under the Trump administration. So, they kind of gave us a good dip buying opportunity. And that doesn't mean that the S&P 500 isn't going to go down for another dip later this year. Totally possible. But if they did, I would buy that one too. Spot platinum rises 3% today. That's interesting. Okay, Punchbowl reporter on X says Trump softens a bit on salt, says that Democratic governors want it. Of course they want it, but been subscribed for a while, always enjoy the... I was gonna say, your name seems really familiar. This isn't the first time you've been here, is it? I know J-Dub is what everybody would always was the slang for Jehovah Witnesses. So that's what I think when I see your name. Anyone have or can build a delta divergence indicator for NinjaTrader 8? Sure. What exactly do you expect it to show? Oh, no, I normally just watch the replays. It's been a while since I watched the lives. Oh, yeah. One who works with Danny. I'm not sure what you're talking about, who you're talking about, April. I'm not even sure who Danny's trades is. Probably I did at one point. I don't know. I do not keep track of I do not keep track of the trading influencer community very well. Kind of was paying attention, and then you know, everybody, mostly because of the ICT thing, and then everybody decided, oh yeah, ICT is a scam, and then I was like, okay, good, everybody figured it out, my job here is done, and then I just stopped paying attention again. Did they, let's see here, is this 0.5 a new, kind of, it's kind of a new low. It seems like it's slowly pushing, but again, I'm not really seeing super strong flow. This 3,000 is probably the biggest number I've seen on like an iceberg, but there was, you know, enough buying split up throughout here for the cumulative delta to mostly be flat. Although I might just need to wait for the close of the bar. Building a platform for space-based commodities to be traded on a decentralized blockchain, meaning the resources of the future. Oh, really? Wait, what are the space-based commodities? Yeah, I could probably take a look. I'm honestly, you say blockchain and I'm immediately like, oh, wow, whatever. I'm in PR, Puerto Rico. You in Puerto Rico? I enjoy watching the bonds, man. I wish I'm not able to stick around as long as, you know, I basically have to leave for work an hour earlier than I did, which really sucks. And there's been some tough trading, but I still just enjoy watching what it's doing. following every little twist and turn. That's the thing that really gets to me when it comes to trading, is that everybody wants to just come in and look at a chart and make their decisions off of a chart. And not only is that not very effective, but it's super boring. It's super boring. You just sit and watch a chart and wait for a specific set of coincidences on the chart for you to take your trade. I would be doing everything I could to try and automate that so that I don't have to sit and stare at the screen all day. Meanwhile, we're coming and we're reading all these things about failed Japanese yen auctions and all of the little nuances of policy, and so it's super interesting. And there's just like no end to things that you can learn about the market, no end to new news and drama to read. It is the, for an ADHD person, it is just the single greatest never-ending source of dopamine available. And everybody wants to stare at a chart. I don't get it. The reason it would be on the blockchain is because space isn't defined by country lines, so something that would be completely open and not based on the dollar or any other country monetary value. That just doesn't make sense to me. I think that I would just price it in dollars and get the legitimacy and access to liquidity that I can get through being on the dollar system. Because once you go to the whole blockchain thing, you basically become like a rogue actor, and certain institutions can't deal with you until you've gotten big enough. It's just like a huge impediment. I don't know. Also, how do you take time before entering a trade? You always stay calm and wait until the right entry? Well, I don't know about that, J-Dub. I think that I take a trade as soon as I realize that there is an opportunity or a flow. I often feel that, or at least lately, I feel like I've been late to a lot of trades. I've missed a lot of really good trades. So that kind of sucks. That's been a deficiency in my trading as of late. But a lot of the time, because it's like, okay, there's definitely a flow going on here, or the flow that I was expecting is definitely coming on here, and I get in, and then it goes against me like almost right away, and then when I bail on it, it goes the way that I wanted. So like a lot of the time I will get in too early. So I don't think that I always get the timing right, and I think the truth is that our ability to really get the super precise timing that we want as retail traders to minimize the amount of risk that we're taking is probably the amount of precision that we want is probably impossible. Once I get into a trade, well, am I relatively calm? Yes and no. When I'm in a live trade, I still feel trepidation about it. I don't think that it shows very well. So I probably look like I'm totally in control because I just keep talking. One of the ways that I deal with it is that I talk with you guys about it, right? But also I've been doing it for a super, super long time. Right? I mean, we've been doing this now for like 8 years, I think. 2017, yeah, 8 years. And it's not a whole lot of money anyways. It's like I'm usually risking at most $50. So that's not a huge deal. That's like the equivalent of taking the whole family out to dinner one time. So how do you balance a working job? Trade treasuries because they open early, right? I have a work from home job. That's the real one, right? Because if you can take your commute and trade instead, that really helps. Shifting my job now and having to drive 45 minutes both ways really sucks. There's nothing I can do about it. That's the current situation. That reminds me, I was reading a thread on, I was reading on recruiting hell. And there was a really interesting thread. Let's see if I can find it again. Here it is. This guy, whose name I'm not going to read, says, "Why are employers so obsessed with finding the perfect candidate, which doesn't even exist? Why are they so picky? Like, why do they want someone with experience? Why can't they just train me? Home Depot made me 3 places of experience I had worked before for experience. I think that must mean that they rejected him. What's wrong with training someone? I just want a job. Stop having such unreasonable standards for a position such as a cashier." Good grief. Wow, that actually is really bad if it's just a cashier. Beer Medir says, "I read somewhere that over the last 40 years, it is now taking 5 times as long to fill a position and 4 times the number of interviews, but actual turnover has remained the same. So there's literally no point. It's systemic time waste." You think you could trade full-time and throw more cash on trades? I've been, well, I don't think that I would ever go full-time. I think that ideally, I would like to trade until 9:30 Eastern time. Sometimes past that if like I'm in a position and I'm just holding it or something. And then do other things. Like ideally make content. That would probably be the best thing. Or work on my own trading platform. I think I would enjoy owning and running my own trading platform more than making YouTube content. Sometimes making YouTube content is really frustrating. Like we're kind of taking a break from making YouTube content right now because we made a lot of content over the last 6 months and none of it really ever broke out. I'm really frustrated. Anyways, let's see here. Going back to this thread. In unrelated news, HR departments have grown in size and power by 5 times in the last 40 years. And figured out that they can infest every company with their friends, but they will explain that it's good because person is known, which makes productivity better. So this is something that I kind of wonder about. It seems to me that pure meritocracy is bad. It seems to me that you have to like who you're working with and that organizations will create cultures and kind of can be like your tribe. That's not as common anymore. People don't really feel any loyalty to their companies, things like that. They're really gutting them in that respect. But not for the sake of meritocracy, for other reasons, mostly greed, right? But you know, if what you were paid was always based on your performance, you know, and you know, especially if your performance was like being updated from day to day, that would be like hell. Like imagine if the market was perfectly reflective of your value to society all the time, right? And you were getting paid by the hour based on that. That would be a nightmare. It would be a nightmare. So to some extent, people need to feel like they have the safety to be able to go in and take risks, and that's where companies can be really successful. So meritocracy is ultimately kind of like is a goal, but not a goal that we're necessarily meant to achieve. Right? We want to implement meritocracy. We want to reward people for their good efforts, but there's a limit to it. It's only marginally an HR problem. The steps HR add typically are legal reviews of job descriptions and so forth. If you want to know the real culprit, it's management. Managers are the ones reviewing all the interviews and BS meetings, re-meetings. Higher-ups want to know everyone and have their input instead of trusting their people on the ground. Middle managers want to seem important by calling all sorts of meetings. Low-level managers don't have a choice. They don't set policy. It's a fundamental misunderstanding of hiring decision making to blame HR when they are only responsible for 10% of the problem. I think that's probably true. It's about sharing the hiring decision between as many people as possible so no one person can be blamed if it turns out to be a bad hire. Oh, well. That's also not accurate. It's about ego. They want to feel important, so they insert themselves into the decision-making process. Almost all of this issue comes back to this. It's the same reason upper management tries to remove remote work possibilities. They like having a measure of control over people, and having them jump at their beck and call is how they can demonstrate that power. I work with these people and have to design systems around their requirements consistently. Our HR team is trying to remove steps and streamline the process for everyone. The people in the room asking why we need 5 interviews is HR. It's the upline managers demanding them. You know what this guy is saying rings true to me. It seemed to me that it was always the managers and the other people on the team that were kind of the holdup, and that many times the teams would have concerns about individuals for like really trivial reasons, and it seems to me that, you know, like this person was saying, we've added more interviews and more stuff, and it really hasn't changed anything. Hasn't changed turnover or anything like that. So we don't really understand what results in a good hire and what doesn't. That's kind of curious, isn't it? Let's see here, J-Dub. I own a transportation company, and I can say as someone who hires people, I think people want to get paid so much for simple jobs, and it's hard to find good work even with training. Well, it's probably even worse. You know, so like I'm a relatively high skill worker. Like I mean, not only am I doing software development, but I'm doing like one of the highest paid portions of software development, because I have to understand a little bit of everything. I have to understand software development. I have to understand infrastructure. I have to understand the software development lifecycle process. And so I come in at this intersection of the project managers, the software developers, and the DevOps people, right? And it's relatively high demand, but I still found it took 7 months to find a new job. When I found the job, they seemed so happy about it. Actually, I'm super happy about it, because I'm seeing things to do, and I'm like, I think you guys made the right choice. I think I'm doing tons of great stuff here. I'm really happy about it. But they said that they hired tons of people, and I really stood out amongst all of them, and I'm kind of like, okay. Because I know that there was at least 1 or 2 other companies that felt differently, and I don't know what was the problem with those 1 or 2 other companies, and what's different from these guys. Is it just random? There's no answer, right? Do you use AI to help you work more efficiently? Yes, but so the thing that I have found with AI, if I come in and I say, okay, here's a problem here. I'm running Terraform and it's giving me an error. I think I know what that error is. I'm going to have to change this, this, and this, right? And I can type all that out, or I can tell the AI what the situation is in the code and it gives me the correct code blocks, right? So the AI helps me write the code faster. The AI will help me web search more effectively, I find, as well. Things that, like, I would encounter a problem, you know, and I'd search and you'd constantly be searching all day, reading through Stack Overflow threads, trying to find the post that actually, like, really reflects what's going on and things like that. And I don't find that happens as much with AI. Like, if it's a known problem and it just knows what the problem is. But it's very, very often the case that it doesn't know what it is, and it will give you an answer really, really confidently, and that's just complete nonsense. So I have to know enough about that subject, that thing, to know when the response that the AI is giving me is bullshit. So I would say with this most recent job that I've been able to use the AI really effectively, and I haven't run into that situation as much. Maybe the AI is a little bit better. Maybe the problems that I'm dealing with are ones that I'm more used to anyways. I remember at my last job, I would have a question and I would ask somebody that question thinking that they would know the answer to it. And instead of them saying, well, I don't know, they would just pass it off to the AI and then send me the AI's response as though it was their own. And then I would go chasing down that rabbit hole because I thought that they knew. And then later on, I found out, oh, you got that from the AI, didn't you? Yes, I did. Man, if you are helping somebody and you use the AI and you give them a response, you should tell them. Because when the AI ends up being wrong, they're going to look at it as you, and you're unreliable or you're stupid. You led me on a wild goose chase, right? So, and I remember that wasting days sometimes in my last job. So, overall, I'm finding that I can be hyper productive with AI, but that it doesn't replace the job. But I am also finding, though, that even though I am more productive individually with the AI, that the team as a whole is not more productive. So this is the other big thing that I'm finding is that the inefficiencies in software development tend to be, more at the team level, integrating things, group decisions, making group decisions quickly, people getting back to you in an efficient manner, that sort of a thing, right? So me being able to write the code faster doesn't necessarily make any of the tickets get done faster. SXP, you're talking about SPX rather? Well, we got back to 110 even, so that's an interesting spot to be. This move over the last 15 minutes, I would say we've gotten about 10,000 contracts short. So that's, that's a small flow, not necessarily one that I'm like, oh, I really should have been in on that. But we could have made maybe 4 ticks from it. I had been looking for maybe there would be some bounce back, and we really haven't seen that. We've got about 20 minutes left. It looks like they're going to push up beyond 110. You're probably seeing some stops trigger now. So watch. When you get the even numbers, that's where people put their stops. It's way more, as in my experience, round number matters more than like a previous day high or low or things like that. In terms of stops. Okay, I want to keep reading this thread. I did a fair bit of research on this when I did my MSc, and I was shocked to learn that essentially none of these crazy metrics we use to evaluate candidates have any better chance to predict job performance than a coin flip. Some, mostly interview techniques, were negatively correlated with job performance. The only thing that came close to being useful is a straight-up IQ test, which is illegal in many countries for good reason. Even then, the predictive validity is very small and not really useful unless you're hiring hundreds of people for the same job at once. I mean, I usually just take one contract. Okay, that now is a little bit further. We're definitely getting a stop, like a little mini stop run here. And they're right that once a metric becomes a target, it becomes useless. Oh, by the way, the robot was short this whole time, wasn't it? Yeah. Ta-da! Wow, so it made the whole 12 ticks on that, didn't it? Oh, yeah. Oh, that's good. That's beautiful. I'm surprised. So over here... Wait, is the market order imbalance really 34? There's no way. I did not realize. So they've never been above 50 today at all. Even though the overall flow has been relatively mild. That is very interesting. Well, that will also, by the way, would make it very difficult to trigger it into another trade because we'd have to come all the way back up to 50 and back down. I kind of wonder to some extent, like, if you're interviewed, you have certain interview techniques, like you do a code review or whatever. And so everybody practices for the code review, right? And so you're not really, basically everybody's lying to you, and we as humans aren't very good at discerning that. We aren't very good at discerning that. And in fact, I think some people might get it objectively wrong. Like somebody comes in and they're being like genuine and, well, I don't know this, I don't know that. You might end up, some people might be more likely to hire the BSer that sounds really confident. So how do you improve that? Any metric that you do will become a target and cease to be a good metric anyways. So I don't know what you do about it. The real statistical best way to determine fit we moved away from a good long time ago, promoting from within and having lower entry-level standards or just using apprenticeships. But that costs money, makes their metrics look bad, and HR loses a core part of their existential purpose to be the mythical arbiters of applicant quality. I'm not sure that that's necessarily true, but I do think there's this thing where like you get hired on and then you move up the company and because they know you and they know your work and things like that. That does seem like a better setup. You see the same thing in academia as a session with the SAT, ACT, etc. Terrible, but the attitude is we can't be counted, does not count, mirror image of the real economy. Except for that, there's been studies recently that showed that SAT, ACT scores correlated better with the students' actual performance at the school more than anything else. And schools are moving towards relying on SAT and ACT more. I'm wondering about this. So, like, after 110 even, I definitely feel that we've kind of fallen into some sort of a stop run scenario. It's maybe only been like 5,000 contracts or so worth of selling. So, I don't know. Like, how far can it actually get? It's already gone further than I would have expected just based on the number of orders. And you don't want to jump in front of one of those because it's really hard to predict how far. You say that the 30-year is running for 5%. I really wish that there was actual liquidity over in the micro 30 so that we could see where it was at. The treasuries are above, or the 10-year is above 4.5 again. Because what I've been seeing is like every time the 10-year gets above 4.5 and the 30-year gets above 5, that like buying comes in and saves it. It seems like everyone defaults to behavioral interview questions, which is crazy because after doing hundreds of interviews as a hiring manager, none of the questions they made me ask really centered around behaviors needed in the role. Anecdotally, it felt like they were more often used as an easy way to say yes or no to someone in a decision that really lacked merit. My favorite is when they get hyper specific, like tell me about a time your client sued you for damages because your criminal negligence led to them losing 25% of their revenue. How did you successfully navigate yourself and your firm out of the situation? Honestly, I feel like they just want a good story and are not at all interested in truth. I think that that's something I've noticed is that humans are really, really swayed by stories. You can make a story. If you can make the story that's like, I lost my job and I had nothing left, so I just, started trading harder and then I became a millionaire. And now I've decided to turn around and teach all of that wisdom to you. Like, people really, they just eat that stuff up. They need that story. Sounds like people are starting to realize those fantastic but it's just the people that are like unemployed right now is the problem there. Like the thing is that I think that most people would say there's a problems in the way that we hire and the way that we're running our businesses these days, right? But what's the solution? Can you show me something, some metric, some data that says we should be doing this? That's what I would really like to see. Somebody asking Activius about MBOs. Have we seen any interesting changes in MBOs this morning? Like maybe that 27 or that 28.5 is a big one. There sure is a lot of liquidity way back up here at 110 even. Okay, maybe we're getting some backwash, so maybe the stops are over. So is that the one you want to take as the hero trade back to 111, back to 110 rather? Let's see. This is the situation where Octavius goes for the hero trade and see if he does it or not. I don't know if I'm getting quite enough volume long to justify it or not. Do you see over here when we started moving down, like the change in the book on the inside. It's very subtle, but you can kind of see that there's more liquidity on both sides. Octavia says no hero. I should note that on this move, it looks like that there has been perhaps some correlation with the Japanese yen. Not quite sure. I think that this down move that we're getting could probably, so it was a net 20,000 contracts now, but that's like over the whole session. But so that could just be endogenous. But if it's not endogenous, you know, I think that it's got to be a flow that we were not anticipating. Some sort of selling related to these kind of larger selling forces that we've had for a while. Another one we want to pay attention to predictors of order flow, but I wanted to ask, what are your thoughts on TPO/market profile? Yeah, so I made a video about improving volume profile. If you go back in to my main channel, and you can go and watch that video, and I think that that's the best explanation of it. Volume profile and TPO were basically attempts to describe some of the market behaviors that we see, but their theories for what was going on are ultimately incorrect. The auction market theory is ultimately incorrect. So I think that by studying volume profile, you might get a lot of ideas about the way that the market is supposed to behave and that are just dead wrong. Okay, so I'd be careful about that. Overall, the sorts of things that you will learn from TPO and market profile, like that, like setups. I also, having done some back testing on them and so forth, suggests that they aren't useful. But I do still have a volume profile up and note things about volume profile. And in particular, I'm trying to predict, as soon as a price starts trading, I'll see something there and go, okay, that this is going to become the new point of control. I want to see that in the way that the orders rented are acting. So I think that learning about market profile and TPOs and everything are useful and valuable things. Like I would go and read Mind Over Markets. Just realize as you're reading it that there's huge flaws in it. There are huge flaws. And, if you've already watched my video where I explain, that mostly what they're seeing is liquidity holes and other empirical properties of order books, and that a lot of volume trading somewhere does not necessarily mean that it's considered value by those traders, then I think you can navigate that. Think we'll be stuck in here at a hole? Well, my algorithm thinks that they're going to buy. I do think that this everything below 110 was stops. And so if that flow is subsiding, then we're going to come back a little bit. I don't know if we're going to come back all the way to 110. They might just settle here at 30. So there might have only been 2 ticks in it. 2 to 4 ticks. But I'm not going to be here to find out, unfortunately. Let's see here. HR department started becoming a thing about 40 years ago. Just a coincidence, I'm sure. Around the time big business started fattening with layers of middle management, and for the same core reason, insulation. It was the hostile takeover era, And middle management insulates operators from within because of redundancies, and HR insulates from employee liabilities. HR getting further entrenched in the hiring process really never was a great idea. It was just cheaper to do so. Lower paid HR professional screening applicants was a job that did at a time go too much more senior, higher paid people who generally were better at figuring out who would succeed there or not by sheer experience in operations. I think that some companies, though, are really good at... So here's the thing that I think is kind of weird about what these people are saying. I'm trying to blame it on HR. Is that it seems to me that HR and hiring professionals and all of that, that the reason that job was created was to entice high-performing professionals. That companies basically found these high-performing individuals that we really, really want are really, really difficult to get. Other people are competing for them too, and how am I going to attract them here? And so we have to have somebody whose whole job is to make the company look as attractive as possible. And I think that that's where that kind of started, and it's kind of changed around because we are in a period where it's really an employer-driven market, because there's not a lot of investment in what do we call it? Venture capital. There's not a lot of venture capital floating around right now. "40 years ago, I got 3 different jobs, the equivalent of a cashier at Home Depot, just by walking in and saying, 'I'm here to apply for the job.' No background check or credit check, just walk in and ask." The person that posted this says that they are autistic and are contemplating getting on SSI. Oh, Social Security. If you can get on it, maybe you should. Dude, my so my 5-year-old has autism. And he has twice now snuck into the bathroom and like started squeezing out all of the tubes of products and stuff. He can open doors and nowhere is safe. I don't know what to do about it. Do you get a sense of how the market might be based on the news the day prior to? Yeah, 100%. Rubner. Or, it's really something that I assess when I start. If you go back and you look at the beginning of the session, you can actually hear me talking, like thinking it out in my head, right? Contemplating whether I thought we would see significant movement today or not. And I kind of thought, well, there's a possibility, but I don't think it's very good. Wasn't as much of an opportunity today. And I would say that judgment was generally overall correct. Although I certainly could have, when we passed 110, tried to take a trade based on the stop run. That's a little bit more short-term of a trade than I like to do, though. Consider, for example, dating to find your spouse. You probably had to date many people. Is it a waste? Probably, but that's how the market works. But you know what? I'm not convinced that the number of people that I dated or anything like that really led to me finding a better spouse or anything like that. Like, what could I go back and do to find the best spouse necessary? But then I think that the kind of my conclusion was my conception of how do I find the best spouse and everything was probably a bad one. That really the best thing was to find somebody that you can have a secure relationship with, and then make them a good spouse instead. And shouldn't that be what, and I guess that's what some of these people are saying is, yeah, you just need to hire people, and you're going to be so good at training and having an organization and a culture and everything that whoever you hire is going to end up being great. Because you will make them the greatest. And I felt like when I worked for Goldman that was how they approached things. They taught me a lot and made me great. And then everybody else has just been reaping the rewards of that. When I finally got into, because I was never hyper productive when I was at Goldman. That didn't come until later. Oh, it didn't like that, did it? Wow. Like, what was that? So I'm usually start leaving around this time, and I was just gonna finish my thought and then leave, but something crazy just happened there. Somebody just dumped like 6,000 contracts on the market. That's pretty wild. So something interesting is definitely going on. We'll see if they recover that. That could definitely be something that could kind of shift it, turn things around. The VPOC did shift, but I've never seen a situation where that causes volume. Man.
Block sell.
It's another big seller. Something's up. Well, I think that would scare me out of any kind of hero trade long now. Do you have any advice for somebody who is starting to get familiar with market predictors? Well, I think that the most useful thing for me has been getting the basic zero hedge subscription and then coming over here and looking for the posts where they post about like Goldman Sachs flow desks and other sorts. So like here's one. If I come over to zero hedge, I mean, they're usually the premium articles, right? Stocks and bonds recovered strongly after the post-Moody's downgrade, despite legacy media's desperate effort to push FUD. Nomura's Charlie McGilligot. So this is one of the best guys to listen to. Okay. Explains succulently why the market refused to follow the FUD as the Moody's downgrade. Simply iterates what the rates universe has already been trading for years. However, one of the eye-opening stats yesterday stems from retail traders. JP Morgan strategist Emma Wu noted that as of 12:30 Eastern Time EST, retail investors net bought $4.1 billion, the largest level ever for this time of day. More than 11 standard deviation move. Retail investors, 36% of trading volume. Another record level. Retail investor closed the day net buying for $5.4 billion. There was not a lot of news in the downgrade. And then the bigger dynamic is that many investors are sitting on the sidelines, so any pullback is leading to dip buying, said Tom Lee, founder of Fundstrat Capital. So we're seeing things about the flows, right? Retail traders are buying. That's one flow. That's probably like the most unpredictable one. So, but you know, as you read through, maybe they will tell us some more things about what different. Well, not in this one. Any weakness from an either weaker flash PMI or consumer sector earnings we think should be bought from JP Morgan. So sometimes these ones will really, really go into detail about where CTIs are. All of those sorts of things. And I think that that's one of the things that's some of the best information. Is Zero Hedge better than Financial Juice? This is really apples and oranges. Financial Juice is the new Squawk. It's the one that's where I get the live information about breaking news and things like that. Whereas Zero Hedge is kind of more after the fact analysis. We moved where were the flows actually coming from? What did the desks report? Okay, well, it's time for me to get going, guys. I will see you tomorrow. Stay sharp, because I don't know, we had some pretty big selling. We are above it now, so that could be the sort of thing that kind of causes a quick snapback. We'll see. In the meantime, stay excellent.